great founders, amazing VCs, and people connected to the startup ecosystem to ensure that you get true thought leadership. Remember, this is CI's flagship program of Western Region Startup Committee. In fact, the good news is that Ravi and me will be starting some mentoring as well in the startup committee soon. So wait for the announcement. But I'm truly delighted today. We have Vikram Gupta with us, a thought leader, a passionate VC, and a person who calls a spade a spade. Vikram is the managing partner and founder of Ivy Cap Ventures, leading VC firm, which has deployed more than 650 million. It's recognized as one of India's largest homegrown VC funds. He has invested in 60 innovative companies, and he actually conceptualized and helped set up India's first endowment fund at IIT Delhi, launched in October 2019. A BTech from IIT Delhi. Where else can we expect a person of his pedigree? And where he was awarded the Distinguished Alumnus Award, and an MBA from Case Western Reserve University, US. Again, where he was honored with Distinguished Hall of Fame. Whatever Vikram touches turns to gold. And I can say it because I've known him for some time. But today, you've got exactly 43 minutes. I've used 2 minutes of this precious time to ask Vikram a question straight up. You will not get this opportunity again for some time. Believe me, he's a very busy guy. So you have a chance. I have a list of questions, but audience, whenever you want to ask a question, put it on the chat and I'll take it as and when it comes. Vikram is a true thought leader and he has such a wide experience. Today's topic is absolutely relevant to his experience, why some startups scale and some stall. We haven't used the word fail, stall, Vikram. It is careful use of words, and Vikram liked that title. We see his pattern recognition. So we're going to kind of try and get everything out of Vikram's brain and get his thoughts, coalesce them, give it to them in the next 43 minutes. I'm going to start up straight. I don't want to miss this chance of asking Vikram some tough questions because he's a tough guy and is going to answer them straight off his hip. Vikram, first one, pattern recognition. It's such a law, kind of a maybe can be encapsulated or in an open-ended word. How much of a startup recognition, startup success is actually pattern? How much is timing and luck? Rest as wisdom.
So first of all, Nina, thank you so much for having me in this podcast. Really appreciate it. It's a great opportunity, and talking to you always is great fun, and always learn from you as well. And I think the number of startups you've done and you've seen, and the successes and stalls you might have also seen. Of course, there's so much to learn from you as well. So
Thank you.
thanks a
Thank you.
lot for the kind words as well. So yeah, so I think to answer your question, um, you know, of course, there is when you look at lots of startups every day and every week, every month, uh, from an investor's perspective, it becomes, of course, quite a bit of number game, right? So when you are deploying from a fund, and typically what kind of investments you would be doing, how much capital you'll be deploying per company. So in a way, you have made up your mind in terms of over a period of, let's say, 2 to 3 years, how much you're going to deploy in what kinds of companies or what stage of companies. And in the process, then you start talking to a lot of founders. And of course, over the last 18 years since I've been investing, and I've been investing across different stages. In fact, I started my investment career as a private equity investor, investing more through a sector focused lens earlier. I set up India's first healthcare life sciences private equity fund way back in 2007 8, and started Ivy Cap in 2011. And ever since, of course, I've been very fortunate to work with different kinds of entrepreneurs and look at different kinds of successes and potential, I would say, bottlenecks in businesses. And of course, multiple things, after you look at multiple things, you arrive at a few things that work and few things that tend to hold you back. So I would say that from a pattern recognition perspective, you get to see some common traits among the founders.
Sure.
And you tend to understand that early on when you start talking to these founders. You get to see why these founders are doing what they're doing, and when you see the passion in their eyes, when you see the passion with which they are trying to solve a problem, I think it's quite visible. So that's one of the things that, after so much experience, that you are able to gather in early conversations. And typically, you tend to figure out when the founders are trying to solve a problem. I think one of the fundamental questions I ask to myself is not just what they're trying to do, but why they're doing what they're doing.
Okay.
And that why piece, I keep, digging deeper till I actually get the real answer to that question. Because it's very important to understand that why part, because the what can change over time, and how is the other piece, how you are solving the problem that you're trying to address, and how you're trying to solve for. The how part can definitely change quite substantially, but the why part mostly remains the core. And that becomes very critical in evaluation of founders, typically if they are trying to solve a problem because they're driven internally to solve a problem. And I'll give you an example. When I was starting IVCap, my why part was actually not just making money in venture capital. My why part was, how can I give back to the system? And I integrated my endowment model right from the stage of conceptualization of IVCap. In fact, when I set up IVCap in 2011, the first thing that came to my mind was, how can I bring together an ecosystem of alumni around the world, starting with the IIT alumni, and how can I give back to the ecosystem? So that why part continues to drive me even today. So my drive continues to be that giving back to the ecosystem. So till today, when we set up our funds, giving back is the core philosophy of our investing. And that's the why part that I keep looking for, even in entrepreneurs, and understand what's really driving them. Is it solving that particular problem? Is it solving a different kind of a problem, or is it something else which is driving them? And I think once you understand that piece, then it becomes much easier to join hands in the journey, and then you enjoy the journey as well, because then you're not kind of just beating around the bush, or saying things which, for the sake of just giving answers to an investor in the board, or just trying to report to somebody. It's more about working together, solving for that why part together. So that's, I would say, and this whole thing revolves around that. The pattern recognition then actually focuses on working on that piece. So that's a kind of a broader perspective on this
No,
question.
great. I think, see, listeners and viewers, this is a this response has got so much depth. A lot of us focus on what and how what's the business model, how are we going to do with the GTM. But Vikram has said something which has got a lot of depth. Why? So please pay attention why. Vikram, in the first 5 minutes, I already started getting questions. So I've got a list, but I'm going to give audience priority. There's a question here which says, when you meet a founder for the first time, what early signals do you look for to indicate long-term potential? I mean, you partly have answered now, but maybe you want to embellish it a little further.
Yeah, I think one of the key things is the founders. need to show their commitment and passion to what they're trying to do, which I just said.
Right.
But those are the signals, many times when the founders come and say, okay, I love the problem what I'm trying to solve. I have a lot of passion for it. The commitment piece sometimes is missing. For example, somebody may not even have jumped full time on a company that they want to work on, but they are waiting for the investor to first take the risk and then they would jump in. So those are the kind of signals which show that they are not fully convinced themselves to solve for what they're trying to solve. So this is just one example, and there could be many others. How they are building their own team, how they are thinking of long-term view, and how they're thinking of situations that can go bad. And many such things, again boils down to the why part. It actually keeps focusing on it keeps driving towards why they're doing it, and that eventually all the questions lead towards that particular motivation. So all the indications that I look for are basically to get the answer to that question.
Sure. So, at our fund, we did a lot of early stage, not the kind of stage where you're on. But one of the things we constantly kind of kept in mind while evaluating is, does this person have a plan B? If there's no plan B, the chances of success, obviously, there's a family business to fall back on, or, going whatever abroad, whatever. Do you see, do you kind of evaluate if the person has a plan B in place, or this is it?
That's a very, very good question. And I'll tell you, these days, the founders, you get all kinds of founders. They're second time founders, third time founders as well. There are founders who are quite smart and would have already got a lot of funding support. And you would see them diversifying their own portfolio, investing in other startups. You will see all kinds of things. But I personally look for a founder who is very committed to what we are investing in.
Sure.
So therefore, they have to be 100% committed to what they're asking for the investment from the investor, right? So from that perspective, I don't I don't want them to think of plan B, even though obviously there has to be some level of maturity and practical view about it, in terms of what if nothing works out. Would they still be wanting to solve for the same problem, or would they do something else? So those questions do come up. But again, this again goes back to the same thing. If they're doing it for the right reason, even the startup doesn't succeed, something inside them would still be wanting them to do the thing to solve for that problem that they're trying to solve for. So even if they don't see the timing is right, or if they don't get the support at the right time, or not from the right people, eventually that passion driving them shows. And you, as an investor, you can make out very easily whether um they're fully committed to the cause, or are they already thinking of plan B in such a way that they are very shallow in their risk taking ability. So effectively, you have to see how much risk they're taking, and are they committed to it. So that's something which you evaluate.
So one more question from audience is, are there any myths about scaling that founders often believe but are actually misleading?
Yeah, I think many times people talk about um, MRRs and translating them into ARRs. And, uh, sometimes the investors also don't fully understand the businesses. And those MRRs translating to ARRs can be very misleading, especially if it's a short period of performance. And I think reading those numbers can be very, very tricky uh, for various reasons. The business may be cyclical, as an example, or there could be some early successes, maybe coming from a single client, So there's too much risk concentration in a single client, for example, and that single client might be just testing it and may not necessarily stay for long. So there could be certain misconceptions like those where you try to build or show that, look, I mean, you are really taking off very well. At the same time, there could be the other side where the founders don't see any traction, but are building a very solid foundation. So they're building a strong business on a very strong foundation, but may not have any revenues, but are building long-term businesses. So investors may make mistakes asking the question only about the revenues and their run rates and things like those, and may miss out the big picture. So I think I've seen both the sides. Depending on how you really read those things, you take a view accordingly.
So, Vikram, I want to push you a little further on this because, I have seen so many founders talking about product-led growth, as opposed to good old-fashioned, going and selling. I don't know, would you put this also somewhat in this bucket?
Yeah, I think eventually a product mindset, even if you have a services business, you have to productize your services. You have to have a product mindset,
Yeah.
and product mindset helps you go much longer and helps you get better out of your offerings. So a product led growth is also more profitable, and beyond a certain point, it also becomes very natural growth. There are points of inflection that you hit depending on the nature of the product and the category of product. The growth curve can be different. But I strongly believe that product mindset is very important.
So, there are a lot of questions flowing. I'm going to sneak in one of my questions because it's unfair. I've prepared so many questions and I'm not getting a chance, but I'm going to sneak in one or two here and there. This is some slightly controversial, but I know you're going to hit it straight off the ground. Are founders today overfitting to what VC want to hear? So, for example, I'm a founder. I want to come to pitch to Vikram. I know so much about Vikram all over. There's so many podcasts. I know what you think. I know your hobbies. I've seen your DPs. So, is it that founders are overfitting to what VCs want to hear, building fundable startups instead of valuable ones?
Yeah, people try to do that, and we've seen that happening many times. But at the same time, if somebody is overdoing it or just doing it for the sake of making you feel good about it, it's not the only discussion you're going to have with them, right? I mean, typically they might get through it maybe in the first discussion and the second discussion. But for the investment to go through it, there are going to be multiple levels of discussions. There are going to be proper due diligence process. There's going to be very deep dive discussions. And you can make up things only up to a certain level. So, in fact, you might be able to impress investors in the first meeting and the second meeting, which does help also sometimes. I mean, I've seen very, very smart founders who are very good at fundraising. So they are very good at catching attention because they know what to say initially or what to write in the emails and how to reach out to the investors, and therefore they're able to get the airtime with the investors. But eventually, only those people succeed who actually have substance inside as well, right? I mean, it's not just catching attention or just saying things for the sake of saying. But to some extent, that also shows preparedness. If the founder has done some homework about the investor and talking the investor language, that's not bad either, right? So that also shows that they've done some background check on the investor as well, and the investor actually appreciates that. So in a way, that's a good sign as well.
Okay, so very nuanced response. Founders listen to it carefully. What he said was really, really important when you go to meet investors. I'm going to go back to questions from audience. How should founders think about scaling? Is it more capital, capability, or clarity?
I always tell the founders that whenever you're thinking of your vision, always think of zero constraint situation first.
Okay.
As so that's why people call it dreaming, right? I mean, when you dream, you don't see any constraints, right? I mean, in your dreams, you can fly, you can do whatever you want to do. So one of the things which I always tell the founders is that, when you think of your vision, always think of zero constraint situation, that everything is available that you want. The team, the capital, the market, everything that you want. I mean, just think of what you want to achieve, and why you want to be there, and then start applying constraints one by one. Because I think the constraints, you have to start applying constraints, then you start checking do the reality checks, basically. Starting with, for example, the market size. you know uh, you can dream whatever you want to dream, but you can't go beyond the size of the market or a particular percentage of the market that you can acquire. Similarly, you can dream whatever you want to dream, even if a $1 billion was available to you as funding, you may not get beyond a certain point. Same thing with you may dream whatever you want to dream. If you don't have, uh, even if you have a certain size of team. So effectively, you have to start putting constraints once you have thought about a zero constraint situation, start applying constraints after that, and then arrive at the funding required and the support required from that there, rather than the other way around. Now, I've seen what founders do. Okay, I should be raising a $10 million round. How do I build a story which shows a $10 million raise? And then they build their dream accordingly, which actually becomes very visible during the discussions, that was it the dream that came first, or was it the fundraise quantum that came first? So I would still encourage the founders to follow the former approach, which is think big, dream big, without constraints. Start applying constraints based on whatever best you can think of, and then arrive at the support system that you need. And funding is only one of the supports that you would need.
I think you've said such an interesting word, zero constraint. I think founders, please kind of imbibe this in you. This is experience talking. This is a person who has seen startups over multiple years. There's one more question from audience. How should founders prioritize between building product, acquiring customers, and raising funds?
Yeah, I think that's also a very interesting question. See, eventually, whatever you're building for someone, right? I mean, you're building for someone who would pay you for it. So I think the first and the foremost thing is actually understanding your customer, who you're building for, and whose problem are you solving, and what problem you're solving. So unless you are very close to it, whatever you build is going to be of no use. So I think if I were starting completely new something, I would spend a lot of time with the customer, doing a lot of research, talking to a lot of customers, understanding their problems, what they're getting today, how they're solving their problem, and what is it that they're not getting today. And that to me will give me a lot of insights into where the gaps really are. And in the process, you will also figure out that many times the customer themselves might become your friends, in terms of telling you that, okay, I will help you build the product. And the customer might be your first investor and might fund your product. And if all your problems get solved, and all the solutions fall in place. So I think it all starts with the customer, in my view. And if you get the right customers, and if things start moving from that side, investors will automatically come. I mean, investors just want to accelerate what is already working, or what they think is going to really work. And if things have started working, or they believe it can work further, they want to just fuel that further. So I would always first focus on the customer, followed by building the product that they believe can solve their problem, followed by talking to investors, and making sure that they understand that I'm solving the problem for the right customer with the right solution. And so that the communication happens properly, they understand that I'm going the right direction. So that's how I would approach it.
Great. See, you've got a playbook in place, customer, product, and then capital. Though, please don't go reverse. And Vikram spoke about it. If you go reverse, it's going to create trouble for you. One more question is, when do you start thinking about scaling, and when do you start thinking about stabilizing a startup business?
Yeah, again, very, very important question. Actually, uh, the first fundamental issue is when you've discovered the right customer segment, you've discovered the product, you know that this is a product which is going to work. Of course, you're still trying to figure out that the price points are right, or your delivery model is right, or your cost structure is right. And in the process, of course, you'll have to balance how much capital you can burn in the process, right? And it's a function of how much capital you have and how much you can raise. So uh, one has to balance these things, and that's a tough game. That's not an easy one, and that requires a lot of maturity, a lot of support, and smarter founders start networking with the people early on, whether it's on the customer side or on the investor side, to make sure that whatever they're doing, they are keeping uh, not only the customer side informed, but also the investor community informed, so that people see that things are working or not working. And you start thinking of scale once you know that a certain metric is actually working. And that metric may not necessarily be actual profit, but you know that there is a profitability metric. It could be based on certain gross margins, contribution margins, and certain spends in certain areas, your marketing spends, are they working in the right direction, and things like those. When you know certain metric has started working, that's when you start putting more conviction to that, and that's when you start thinking of scale. So of course one has to optimize on what variables to pick first, because many times the challenges are always, should I scale up in the same city, or should I go across three cities altogether and then excite an investor showing that, look, I can scale across those three cities while I'm still not profitable in the first city. I would say that I would first try to optimize on the core metric and justify the market product market fit, and the fit in terms of the profit metric. Once I've done that, I think then it becomes easy, because even if your capital or fundraising gets delayed, at least you figured out that you can survive. And therefore it's important that you start thinking of scale once you hit that threshold of the metric that you plan for.
So there is a question on red flags. I also have a question, but I'll take the one in the audience and then I'll add mine. What are some of the red flags that you see immediately after a founder pitches? What makes you cautious? Just let's say two or three. I mean, don't have to be elaborate.
Yeah, see that red flags are usually around founders' commitment to the cause. And I personally spend a lot of time understanding how they structured their cap table, for example. And if they have given up a lot of their stake early on, and or used a lot of capital already to reach a certain point and have not really used their capital efficiently, or raised capital at a very high valuation. That's again, I mean, which means they may not have diluted too much, but the valuation they got in the last round only because their angel investors didn't ask the question. They trusted the founders and they said, "You decide the valuation." So in both the cases, when you overvalue or undervalue a company, it could be challenging. So that becomes a red flag in terms of how they structure their cap table. Then also look at how they build their team, how they define their roles and responsibilities. Of course, in early stages, uh, you have to play multiple roles, and the team dynamics start showing very early on. So if there are two founders, three founders, how they are communicating with each other, how they structure things between each other, how they have uh, structured their roles and responsibilities. So things like those become very critical for us to evaluate. And of course, then one starts looking at deeper in terms of the product market fit. Is the product really working, not working? So those things fall in place, and accordingly, you take a call.
I have a question, red flags, but you mentioned about founders. So maybe I want to push you a little bit on that in terms of pattern recognition. You've seen so many startups. So we have startup with a single founder. Sometimes we say, no, no, that's, you should have some one more founder. Then we have startups with three founders. That is good and bad because, there's possibility of conflicts. So as a pattern, what is a good situation to be in?
So, Ninad, this is something very interesting because earlier I used to say complete no to single founders.
Yeah.
And I've also said no to a team of seven founders, all with same equity in the company, all IIT IM founders, uh, and with a great idea, brilliant idea. But seven founders, somehow I just couldn't understand the complexities of the roles and responsibilities that they were dividing amongst themselves. It was not very clear. The optimal is two to three founders.
Okay.
But very recently, I've started investing in single founders as well. Snitch is a single founder.
Okay.
Uh, and it's really shown how a single founder can take something which comes across as a very crowded space idea into something which is created as very unique and executed extremely well. So I've also learned over time that as long as the single founder has built a very solid second layer with the right structures, right incentive models, and has the right mindset to understand the risk of a single founder and therefore build the right backups. As long as those things are in place, then you would invest in the single founder. But of course, as I said, two to three founders otherwise seems to be an ideal situation.
So I'm going to go off our topic a little bit because, as you know, it's getting interesting. Sam Altman has said that we will see a single person unicorn. Uh, Now, coming back to your kind of acceptance that yes, single founders are not necessarily bad. Uh, so he's gone the other extreme, saying we're going to see a single person unicorn soon. What are your views on that?
I think Sam Altman saying this, one can totally believe it, given the fact that AI is doing almost everybody's jobs now. And, I also heard of this AI app raised $10 million on its own without even a single person founder there. If you can, one can see a situation like that, then a single founder, a single person team unicorn is also possible because you may be solving a problem which has never been solved before because the product itself is doing all the work. You may have created the product which is doing everything that needs to be done. And I wouldn't be surprised that uh, that happens sometime in the near future. The
Okay.
world is changing very fast, and especially any B2B startups where a lot depends on the product and the eventually, why do you need people? You need people to sell your product, then you need people to implement your product, and you need people to solve any customer issues, and then you need people to continue to grow your product and evolve that product on a roadmap. But if your product is AI enabled, self learning, and self implementing, self selling, then you can achieve everything with just that product.
So, viewers, you have got exactly 10 minutes more. This is your chance to ask a question straight to Vikram Gupta. Don't miss this chance. I'm going to stop in exactly 10 minutes. So, please Don't wait to ask your questions. If you have something, ask them. Given your experience, I'm going to ask this question from audience. How can founders maintain culture and agility while scaling rapidly?
Yeah, I think that's again a very good question because typically what happens is as you are building a team, you are adding new backgrounds, new value systems, and new ways of working in the team. It becomes extremely challenging to maintain a common ethos, common value system across different stages of the business. I think that's where it becomes very important to define your core ethos and the core team upfront. And if your value is articulated very well upfront and repeated every time you hire people in the team, everybody lives by that, everybody works on that, then it'll be less challenging. It will be challenging because every time a new person joins the team, they bring their own set of values, etc. And eventually, the combination of the entire team defines the entire value system and the culture of the organization. But then it's really defined by your recruitment process, how you recruit your team, and your training, how you train each other, how you support each other. So it requires a lot of focus and um, maturity at the founders level to make sure that they keep working towards bringing the team together and taking the team along.
There's a very interesting question just popped up. I was about to ask, I've just managed two out of my 10 questions, huh? But anyway, I'm giving priority to audience. Very interesting. What unique advantages do Indian startups have when it comes to scaling globally?
I use this example of Chandrayaan 4, which was the entire project was done with $75 million, where the NASA's project to moon was just the pilot project was a $4 billion. So I think the mindset of the Indian founders is capital efficiency. And jugaad is a word which has become very common in the Indian parlance. And we're always looking for methods to find better ways to solve a problem more efficiently at a much lesser cost, which I think will eventually become the winning formula for the Indian entrepreneurs. And I think we are seeing Indian entrepreneurs, even who are going and setting up in the US and in other geographies, they go with this mindset and therefore do much better than other founders, raise much lesser capital to reach the same level of outcome. So if you do an analysis of Indian founders working abroad, how much capital they would have raised to reach a unicorn status, you would see a difference of at least 50 to 60% on an average. So, which is actually quite encouraging. And that kind of, in the long term, you will see that value actually multiplying, and therefore a lot more coming from the Indian founders.
So let me ask you a question. And knowing you, you always speak straight from your heart. If you had to give one brutally honest reason why some startups stall, something that founders don't want to hear, what would it be?
I think it's lack of cash flow planning.
Okay.
In my view, what happens is that many times founders will assume that, oh, next round will happen, or assume that, oh, money is coming from somewhere, or just overestimate revenues or underestimate costs. I think that is, I would say, if there was only one reason, and then suddenly they will hit a cliff where they're neither here nor there. If you plan your cash flows well, and not every founder has the skills to understand that, and therefore they need to have those skills in the core team. If they don't have the skills themselves, make sure that somebody in the team actually keeps looking at that. Eventually, what kills you is end of the road. You are out of your cash
Okay.
and you don't know where to go. So lack of planning in doing that.
So if three IIT, I'm just doing IIT, let's say great tech founders come and they're great coders, because they're talking of cash flow. We have seen the movie before, you and me, but they come and they tell, you love the idea, then they tell you, Vikram, I mean, the finance is damn tough. I can't understand head or tail, so don't expect. How would you advise them? What would you tell them?
Yeah, so that's where a VC also brings value, right? I mean,
Correct.
part of the value that we bring to the table is helping them beyond what they already have. And part of the skill which we see missing in, especially in techie teams, is planning their cash flows and planning their forecasts, planning their team hires, the right kind of hires. These are the areas where most of these people lack good skills on and access to good talent, access to good markets. Um, so these are some of the things where good investors can make a huge difference. And that's why I think these founders should actually do a lot of homework before bringing investors on board, understanding how these investors can add value to what they're doing. So always look for complementary skills. So if you bring an investor who's also a techie only, and who's made money because he was a technology person, his product was great, and but he doesn't have the finance skills, you will get capital, but then you would still need uh, skills related to finance management. So that is something which is very important.
So we'll start winding down now. I had promised Vikram that he'll be free at 5:45. He has covered a wide range of topics. I started noting down and then I lost track because he said so many interesting stuff. He started by giving advice of a zero constraint situation. Very important, founders. It's a very, very deep thought he has given you. Then he spoke about customers, product, and then capital. Don't go other way around. Have capital storytelling and then figure out customers and market. He spoke about cash flow, proper cash flow planning, complementary skills, multiple things. This was a great session. This will be available live or recorded on YouTube, and this link will be available. So if you want to share it with people who have not seen this live, they can always go on YouTube and see it. Vikram, I can't help but wind it down with our round of rapid fire. Uh, and please, indulge me for next 3 minutes. You have to just select one of the two. So let's have a bit of fun, in winding down. So I'll give two options. You have to just select one. You can't say neither, both.
Okay.
Uh,
Okay.
Founder or market?
Founder.
Speed or discipline?
Discipline.
Profitability or valuation?
Profitability.
Conviction or consensus?
uh, Conviction.
Pattern or outlier?
Pattern.
Spreadsheet or gut?
Gut.
You've done great. And the last one, last one. Next life, would you like to be a VC or a founder?
I'm both, by the way. So I'm a founder and a VC. So I would love to be both in next life as well.
That was truly amazing, Vikram. Unfiltered, unplugged. You've given so much sage advice. Your years of being a VC, years of seeing so many founders, years of seeing so many startups scale. This has been a great session. I have truly enjoyed it. And I've seen so many questions. Some of them I couldn't respond to. You've got a great audience. We are really thankful to you, Vikram, for sparing
Thank
your
you.
time and sharing
No,
your thoughts.
thank you, Rina. Thank you so much. Really enjoyed this session.
Your 45 minutes will go a long way in helping founders because each of your responses had some deep thought to it, and that's the only thing I can expect from you, Vikram. And thank you again. Thank you for joining us. Thank you.
Thank you so much. Thank you so much.
Thank you.
Okay.